Robert, very good morning and great to have you on the show today. Now, which part of Jerome Powell's commentary would you take most seriously? Is it where he says that we've acted fast enough and now it's time to slow down? Or the bit where he says that the dot plot is not cast in stone? It is just the view of members of the Federal Reserve and things can change.
Absolutely. It's a fantastic question. And really, I would highlight both of those factors that you just mentioned. First and foremost, as you noted, and as you played with Powell's clip before our session, they're increasingly concerned about inflation risk. Part of that's because inflation has been a little bit stickier in some recent prints in the U.S., not drastically so to really change my view that inflation is gradually moving back down the target, but it's been a little bit stickier. But the more important point, I think, that's implicit in a lot of the communication is that we have the Trump administration coming next year. And when you add up a lot of potential Trump policies, to us, they look more inflationary than disinflationary. So we are also concerned about potential upside risk to inflation. And that might mean that the Fed would have to go a bit slower. At the same time, though, I think getting to the point about the dot plot, that as Powell also highlighted, and as you mentioned, this is not a set in stone path. Right now, they're looking for 2 rate cuts next year. But as we've seen throughout this year, their guidance about rate cuts has changed significantly as the data and economic environment have changed. So I would very much think that next year, as he said, they're going to respond to the data. They're going to respond to what the Trump administration ultimately does and how that affects the data. And so I think that's also true as well, that this is not a firm commitment of what you see in the dot plot. And it's really going to require us to stay on our toes next year to monitor the data closely in terms of what the Fed's going to do.
Most certainly. Robert, good evening to you. But here's the deal. Right now, the Fed is sounding hawkish. And we don't know what the data will look like. But if indeed tariffs on China are raised from 20 to 60, as President-elect Trump has said, it will be inflationary. And if that is the case, the likelihood of rate cuts go out. Don't you think? I saw your note. I mean, you guys are saying that labor market weakness will prompt the Fed to cut. But what if it is inflationary in nature, which is the tariffs, and that actually prompts the Fed to not only stay put, but maybe even hike?
The tariff situation, I think, is what has the Fed on the most alert and is the most concerning, because depending on what Trump's tariff policies look like, it's not even clear what the Fed should do in that environment. For example, if Trump just puts some additional tariffs on major trading partners, increases tariffs a bit on China, you get a bit of a boost to inflation in the U.S., a bit lower growth, kind of a stagflationary shock. Yeah. The Fed is likely to look through that if it's relatively mild. If you get big tariffs and retaliation from other countries, then I think the Fed is actually likely to cut rates in that environment because you get such a big hit to economic growth in the U.S. So it really depends on the flavor of tariffs we get. And I think that is the biggest question mark for the outlook, is what type of tariffs will we get on China? What type of tariffs will we get on other countries? And then what will they do in turn in terms of putting tariffs back on the U.S.?
But Robert, sorry, I'm just playing the devil's advocate here, right? One, that the Fed has unequivocally sounded hawkish, part one. And two, yes, I buy your point that there could be weakness, economic weakness, but the Fed thus far has probably shown itself to be an inflation targeting central bank, if you will. And if tariffs come in, it will be inflationary in nature. And therefore, does it tie the Fed's hands in order to do something to boost the economy, even if it wants to?
It's exactly very challenging environment, especially coming off, as you said, the environment we've been in the last few years, where the Fed is scarred from a period of very high inflation. And even if you get a temporary inflation boost from tariffs, the Fed is going to be worried about what that might do to longer run inflation expectations. And they may feel the need to fight against that with rate hikes. But at the same time, as you noted, you also get those negative effects on economic growth, which would call for potential rate cuts. So it's going to depend on the size of the effects and ultimately what the Fed is more worried about. I think in an environment where you get some tariffs and some inflationary effect, you could get the Fed stay on hold for longer, or potentially hiking a bit if they're not as worried about the effects on growth. Not even hiking, but holding rates higher for longer than they would otherwise. I think the bar to hike, though, is very high. It could happen if you get a big boost to inflation next year, but I think it's very unlikely. I think the more likely scenario is what we saw today, is that you get a much slower moving Fed, even if you get a little bit of inflationary effects from tariffs.
I think the key word here is uncertainty. The Fed's not sure what's going to happen post-Jan, and that's reflecting in their commentary. But then let me come down to the point, Robert, when we're talking about what this means for emerging markets. And this morning we're sitting and speaking with you before the Indian markets open up. Our indicators are showing we're going to have a very rough start. Most of Asia already has. I'm just trying to understand that how India is now looking in terms of an emerging market play, with perhaps the interest rate cut trajectory slowing down.
Yeah, it's a key point within our forecast is that the emerging markets are in a very good place going into 2025. They grew at around 4% in aggregate in 23. They grew around 4% aggregate this year, and they're going to grow outside of China, where we see some risk. They're going to grow around 4% EM ex China next year. So very resilient story. India is one of the biggest stories of resilience within that picture. 6.5-ish, slightly above % growth this year, similar growth next year. So I think India is in a very good place, even amongst emerging markets, which have been relatively strong. Now, in terms of what the Fed's decision means for emerging markets, right now in our outlook, we're expecting a wide range of rate cuts globally. Most developed markets and most emerging markets are expected to cut rates. But with a potentially slower moving Fed, one where you don't get as much rate cuts as were expected, that's going to be challenging for central banks in emerging markets as well. And it might be harder for them to put through the rate cuts that we're expecting if the Fed is higher for longer than we currently have in our forecast. So I think that's the big challenge, is if the Fed is worried about inflation risk, worried about 2025 risks, and they stay higher for longer, that's going to be a challenging environment for EM central banks to continue cutting rates as materially as we've been expecting for some time.
What about EM equity? What about Indian equity as an asset class or as a bucket of investment?
Yeah, I mean, given the growth picture and the very positive long-term trajectory, I think that there is a strong story to be made for continued support of India equities and more broadly of other EM equities as well. The challenge, of course, is what is going to happen. Again, we come back to the tariff environment. We just heard some recent chatter out of Trump and that India may be the target of some tariff as well next year. And that would be very concerning, I think, for the Indian economy, but also the Indian equity market. So given where we're going next year, there's a lot of risk in the global system, even though we're having a very resilient picture. And again, I come back to, I think tariffs are the #1 risk to the global outlook next year, not just for the US, but what it might mean for the rest of the world. And I think, as I mentioned, India is coming up more in the news as a potential risk there. China is, of course, the #1 risk in terms of tariffs and the Trump administration. So this is something we're going to have to watch very closely. But broadly speaking, outside of that, I think India's growth has proved to be very resilient and we expect to continue to be so next year.
Okay, thank you so much, Robert. Always a pleasure speaking with you. Robert Sockin there.